Okay, hello everyone, my name is Joseph Song. The channel is called Ethernet Wink. In today's video, what I'm going to be doing is breaking down an options strategy that I found from Barclay. Now, I did not find it myself, I found it from a YouTuber named Benjamin. Great content, by the way, I love that guy's channel. I will link that in the description as well as the research report PDF in the description. Now, I'm going to try and do this as quick as I can because I recorded this 5 times already. 5! That's a record for me, alright? I normally have to record them more than once, but never really more than 2 or 3 times. 5! This is number 6. That's crazy. Anyways, enough about me. Let's get into this content. But before I do that, I want to thank you guys for the increase in views on the channel. I have 2 videos now with over 70 views, and I have over 20 subscribers, which is great. Of course, the goal is to eventually have over 1,000 subscribers, so that way I can get paid for this. You know what I mean? I'd love to have a second stream of income from this. Nice little beach in Cabo, 4GT, live the life. But in the meantime, I gotta make this video. You understand me? So, also, this is not financial advice. This video is for educational purposes only. Yada yada yada. Okay, let's get into this PDF. So, what I'm going to do is I kind of picked out some parts of this PDF that I found to be more important than others while trying to understand why the trades worked. So what I'm going to do is explain all of that and explain the trades, or the strategy, and then leave you guys with that. That's basically going to be a why on why this works. And in better terms, pretty much just putting this into people language, because when we get down here to monetizing retail-driven options volatility dislocation. What? If I was new to this and I found this on a YouTube video and I clicked on it and I read that, I would click off. I might even close the account after I read that. I would be sick to my stomach. But that is why I am here. I'm here for you guys. Here for education. Okay, here for what I'm here for. So. Let's kick things off. So, I'm going to be reading from down to here at one point. I just want to let you guys know the area, because what Barclays has found is that the increase in buying power and the increase in buying of options on single stocks has led to a big difference in the single stocks behavior versus the rest of the market. So, in essence, after the pandemic, synchronized with retail brokerages lowering. So, after the pandemic and synchronized with retail brokerages lowering trading commissions to 0, single stock options have increased. Single stock option volumes have increased 3 times on a year-over-year basis. Continuing the quote, that was a quote. Single stock option volumes have increased on 3 times on a year-over-year basis. The increase in volume is concentrated in short-dated, less than 2-week maturity calls, and particularly in large-cap tech stocks. Increase in volume has been much more significant than the increase in open interest, which indicates that this is speculative intraday activity. We provide evidence that the major increase in option volume is being driven by retail investors. Excuse me. The spike appeared when major retail brokerages cut commissions to 0 in October. In October of 2019. Buy orders for small lot call trades, a proxy for retail orders, have increased significantly, and they now represent 40% of overall call volume. 2022 Q2 13F data shows that direct retail investors have been major buyers of large cap equities. Another paragraph, but first, I want to say that this was done on September 14th of 2020, so pretty old, but not that old. So, the option trading activity has significantly impacted the volatility surface for affected stocks. Due to the increased demand, implied volatility for shorter dated calls have increased relative to puts and longer dated options for stocks, with a large increase in option volume. Interestingly, the volatility risk premium, VRP, implied volatility versus subsequent realized volatility, has not increased meaningfully, indicating that realized volatility has also increased in tandem due to more speculative trading and hedging activity of market makers. Our single stock SS option strategy, which sells options based on a vol score methodology, has outperformed the corresponding SPX option benchmark. Sweet. Now we got the basic why. What's going on? Just single stock option volumes that increase 3 times on a year-over-year basis. It's mostly short-dated calls. It's mostly intraday moves. It's mostly retail. All right, now let's get into a few more of the moving parts, so that way we can understand why these things work. I'm losing it in my recording. Spiral out of control. So I'm going to read from here down to here. Despite the significant uptick in speculative options activity and option market makers stuck in short gamma positions, VRP, volatility risk premium, measured as the difference between 1 month applied volatility and subsequent 1 month realized volatility for top 100 SS basket has actually declined relative to VRP for single stocks with lower options volume. When we look at volatility risk premium to see if premium was impacted by the uptick in trading activity, we plot the 1 month VRP for both the top 100 and rest of the universe single stock names. While there was a significant impact on the absolute levels of VRP itself, which led to the expected, during the sharp sell-off. During sharp sell-off, given the strong rally in the aftermath, the VRP recovered for both the top 100 and rest baskets for the VRP. Then the VRP for the top 100 is now lower than that of the rest. Okay, this is puzzling considering the implied volatility of the top 100 basket has increased given the higher demand and should be, in principle, cause them to trade at a higher premium to realized volatility. The above result implies that even realized volatility has increased at a faster pace for the top 100 stocks. Okay, so what does this mean? Figure 18. We're going to look at this here. Demand for shorter dated options, specifically in stocks with the highest option increase, top 100, has driven the term structure spread to decline to the lowest level in 5 years. Basically, alright? Well, I'm going to explain some more. Rest single stocks, top single stocks, and the spread. These things are close together. The volatility risk premium and the spread of this is very close together, these things, and that is not typical. This goes back to 2015. The other closest part was in 2015. Very not typical. So, and before we go forward, we really need to understand what is volatility risk premium. Volatility risk premium measured as the difference between 1 month implied volatility and subsequent 1 month realized volatility. So, subtraction of implied volatility and realized volatility. But what was said in here means that realized volatility has not increased in those examples of the top 100 single stocks. That means that these stocks they studied did not have the volatility that was priced in. They moved less in context with the high implied volatility. The volatility they were pricing in is not happening at a larger scale. Okay, that makes sense. I hope it does because it has to for these trades to work. So the next thing we're going to do is we're actually going to go back to page 10. And that is because we need to know what the skew is. Skew, wow, the skew is the difference between put and call implied volatility. That becomes very important for one of the strategies. And now, on page 11, I'm going to read one little part before we get into, actually 11 into 12. I'm going to read a little part before we get into strategy. So I'm going to read from here. Actually, no, I'm not. What am I going to read from? I'm going to read a lot. I'm going to read from here down to here. That's where the value is found. And I'm also going to explain this figure. So, skew is an indicator of relative demand for put versus call options. Based on the spike in investor activity we have highlighted in the previous section, especially in call option trading, we would expect the skew to flatten, driven by upside demand. We showed the market cap weighted 1 month normalized delta skew for the top 100 and rest of the universe in figure 17. The skew for the top 100 names has historically been steeper than the rest of the universe. The 1 month skew diverged significantly during the 2020 sell-off as the skew for both the top 100 and the rest of the universe steepened. We find that the impact in the uptick in trading activity in single stock options led to a significant flattening of the skew, especially in the past couple of months, for the top 100 names relative to the rest of the single stock universe. Similarly, a similar dynamic was seen early in 2018 and 2020 when stocks had rallied sharply as we witnessed corrections in February 2018 and March 2020. Figure 17 skew in the large caps has flattened significantly relative to the rest of the stocks, indicating excessive bullishness compared to the rally in 2018. So the dark line is the 1 month skew for the top 100, and the lighter line is the 1 month skew for the rest of the stocks. And we see rise, steepen. It's basically just steep in both directions is what they're getting at, and that's that is unusual. Demand for shorter dated options has led to a flatter term structure. Investor demand for the options, especially in the shorter dated options, has impacted the implied volatility's term structure, especially for options with the highest options trading activity. In Figure 18, and I'll explain that one as well, we show the aggregate term structure, top 100 and breadth backtest, with the term structure defined as the ratio of 1 month over 3 month implied volatility. So 1 month to 3 month implied volatility is what is measured down here. And that is what the term structure is. As expected, in times of risk-off events, the term structure ratio rises or flattens, driven by investor buying of shorter-dated volatility. Driven by investor buying shorter-dated volatility. In 2020, the absolute levels of the 1 to 3 month term structure for both basket of stocks rose dramatically during the March 2020 sell-off and has since reverted closer to historic levels. But on a relative basis, the spread between the term structure for the top 100 options basket versus the rest of the universe has collapsed, despite the absolute levels of the term structure settling lower. The declining term structure spread indicates that the demand for options investors is leading to higher 1 month implied volatility on names with the highest increase in option activity. So demand for shorter dated options, especially in stocks with the highest option increase, top 100, has driven the term structure spread to decline to the lowest level in 5 years. So the term structure, rest of the single stocks, top single stocks, and the spread. Now we know that the term structure is considered to be the ratio between the 1 to 3 month implied volatility. So what does this mean? That the 1 to 3 month volatility of longer dated options and shorter dated options are basically the same. That's weird. That does not normally happen, and that's one of the things that they notice. So now with all that out of the way, we can get into the strategies. And I'm going to be talking about it more so that way we can tie it all together. But here we are again, monetizing retail-driven options volatility dislocation. I want to vomit when I read that. Okay, so we're going to vomit even more when we read these things, and then I break it down, and you realize, oh, that's all they're doing? Terrible. So, monetizing elevated volatility using selective vol score-based short the delta hedge straddles on single stocks. So, what they are doing is they're just betting on the stock to not have the move that they are pricing in. Delta neutral means that the change in price in one part of the thing gets offset by the change in price in another part of the thing to the opposite direction. That is very simply put. Or they're basically short and long in the same thing, the same amount. So no matter what the price change, the price won't change from the price of the underlying. So what that means is, let's say they're doing this on a stock XYZ, and they did it while XYZ was at 100, and now it's at 101. That, theoretically, the price of their position could have not changed at all, just from the price. So, what they do need for a change in the price of what they're trading is nothing. We know that options are priced by delta, gamma, theta, and vega, and delta, gamma, theta, vega, and IV, implied volatility. We know that they're delta hedged, so delta and gamma don't really matter, and as we're told above, these are short straddles. So, theta and vega, indirectly, are working for us. Furthermore, this is a short straddle, so we want the IV to not increase. We want the RV, what am I saying? Furthermore, we are short of strategy, so we want the IV to not increase. So we want the RV to not increase. In the past research they've done indicated that this would be the case. They were betting on the stock to not move outside of the range of their strikes. Also, we know that options are expensive from high IV, so they're short at a good price, and shorting something with high IV on something, the same thing, having low RV. So, I'm going to break that down a little bit further. I wrote that down in my script, but I can understand why that would be very confusing. So what is a straddle? A straddle is a neutral option strategy that involves simultaneously buying both a put option and a call option for the underlying security with the same strike price and the same expiration date. The trader will profit from a long straddle, pay attention, a long straddle when the price of security rises or falls from the strike price by an amount more than the total cost of the premium paid. The profit potential is virtually unlimited, so as long as the price of the underlying security moves very sharply. So, the strategy is profitable only when the stock either rises or falls from the strike price by more than the total premium paid. So stock either rises or falls a lot. And they're long, but we're short. So we want the stock to do nothing. We're basically betting. We noticed through this research that the implied volatility on the stocks is very high, but the realized volatility as a result hasn't changed. So what they are doing is basically betting on that to continue. They're betting. They're looking at these options that have such high IV, and they're selling those, and then the options have such high IV on the security with such low realized volatility, with such low RV. And so they're basically saying that these options are very expensive and they should be cheaper. In theory, that's what they're doing. They're betting on the underlying to not move as much as the options priced in, so the options pricing to change and revert back to a mean, just go down, and they're short to be profitable. That's strategy number one. Strategy number two, buying outright call spreads and 1x2s on resilient stocks to monetize extremely flat skew and attractive VP. Now, one thing I want to say before we keep going is that this previous strategy was on single stocks, not the resilient stocks. So if I can find this quickly, because I didn't put this in a part of my script, but I just realized it. Here we go. So here we have the resilient stocks. They're betting on not these stocks to not move, all right? Because think about it. During the pandemic, if you're betting on Tesla, Amazon, Apple to not move, you were out of your mind. But these are considered the resilient stocks. They're talking about just the single stocks, just the other stocks that they studied that didn't have this source of behavior. So that's why it worked. It was not on the strategies that, so I wrote this down and I know I had it. It was not on these stocks that found that the volatility risk premium indicated that realized volatility was going to increase. All right. It was not on that group of stocks like Tesla, Apple, Amazon, not on those. These kinds of stocks are the resilient stocks. So they were not the stocks that they were betting on to not move. In fact, they were doing quite the opposite. And they're buying outright call spreads of 1x2s on resilient stocks to monetize extremely flat skew and attractive VRP. Before I say what flat skew and attractive VRP means, what's a call spread and what's a call 1x2? Well, a call spread, also referred to as a bull call spread, means, I should have looked at this article a little more, means that we're buying call option, bull call spread. A bull call spread is an option strategy that involves the purchase of a call option and simultaneous sale of another option with the same expiration date but a higher strike price. It is one of the four basic types of spreads, or vertical spreads, which involve the current purchase and sale, two puts or calls with the same expiration or different price. Two puts or calls with the same expiration but different strikes is the English of that. Excuse me. So basically this makes entering a position for upside way cheaper, and that'll be attractive to them because of the quote-unquote frothy valuation. So now I'm going to put this into my simple words again and then explain skew and attractive VRP. So basically what they're doing is they're planning on taking advantage of these stocks going up in the risk-off scenario that we saw in 2020, excuse me. They're doing this in the form of spreads because in their eyes it is more quote-unquote prudent, as well as is better risk with the time of frothy valuations. With just my eyes and hindsight, I can see this worked well because of the IV on the stocks, the opposite of what they did above. Hopefully this will make you understand that a little more. In my memory, I don't feel like I explained it that well, but I also think I did. I just don't think I put it in people terms that well. I feel like I explained it decently. But back to this now. What would a flat skew be? Well, first let's talk about what they really boiled down and we'll put this in really, really simple language. They bought low IV options that met their expected RV and sold the high V options that did not meet their expected RV. That's basically the difference between the two strategies with it. But what is skew and attractive VRP? So the skew, as we know, because of the other little checks that we did, is the difference between put and call implied volatility. And the volatility risk premium is the difference between the 1 month implied volatility and subsequent 1 month realized volatility. So, what this means, all that this means, is that the IV is low. The IV is low in comparison to what it was or what it is in other parts of the market. And I just realized I didn't explain what call 1x2s are, so we're going to come to fill early. A 1x2 ratio volatility spread with calls is created by selling 1 lower strike call and buying 2 higher strike calls. This strategy can be established for either a net credit, as seen in the example, or a net debit, depending on the time to expiration and the percentage distance between the strike prices and the level of volatility. So we sell 1 call, 100 call at 330, nice big credit right there, and then we buy 2 calls at a higher strike for $150. So we actually would end up with the credit in this example, and we would want these to increase in value, but just at a sharper pace than that would decrease if we're betting on upside with this. So back to this. Back to both these strategies, because I feel like in me explaining these strategies individually, I'm losing it, you know what I mean? But when I explain them simultaneously, very simply put, because it is so simple, but I feel like I'm nutting it up. We're going to get into this. So, monetizing elevated volatility using selective vol square based short delta hedge straddles on single stocks. They noticed, I'm gonna so I can see myself. They noticed that on specific stocks, the options had such high implied volatility, but the underlying had a low realized volatility. The underlying did not move as much as these options were pricing in. So that made these options expensive because they were pricing in something that was never going to happen. Now, they shorted those. They shorted the expensive options, betting on them to go down and be at an actual good price, a good fair price. They did the exact opposite in the other scenario. They said, okay, well, this sector of the market has really high implied volatility and low realized volatility. Let's short those options. Okay, this part of the market has really low implied volatility and a really high realized volatility. These implied volatilities are getting realized. And so they thought these options are cheap. They bought those. And as we see, now it worked. I feel like I took so much time and I could have explained it just like that and made it a lot easier. But that's all. That really is all to this strategy. So, I hope that you guys walk away learning something. And I know this was written a while ago, but I can see a similar scenario, only in a little backwards working. I see a similar scenario, only a little backwards working in a past market condition. Like, imagine what this would be in 2022. It would pretty much be like an edge, like basically similar ideas of IV and RV, but bearish bets on the market and something that can capitalize on corrections better. You know, I feel like that could work in 2022. However, it's not 2022 anymore, actually. It isn't. It's 2023. And this was written in 2020. And I really hope that you guys understand what they're doing here a little bit better and can even make better decisions for yourself now. Again, once more, selling these expensive options, buying these cheap options based on their volatility risk premium, skews, and volatility score. They didn't say how they calculated that. Actually, they might have. I don't know if I went into it that much. But that is it. Again, nutshell, because I feel like I muddied this up big time. Selling expensive options, buying cheap ones, based on volatility. Very simple when you think about it. So, I hope that you guys learned a lot from this. Now, I myself, I made a strategy, not very, but sort of similar to these. It is not either of the two strategies, but I want to show it without showing any of the code, just a back test. This is January 4th, 21 to January 31st, 23. And so here we can see it just working decently well. We have a 86% win rate and Our average win is way bigger than average loss. Sharp ratio almost 1. And I know it was good, but what I want to do is see if I can get it for you guys from, say, 2019. So that way we can really see what happens during 2020. It might break. I really don't know. I didn't spend a lot of time on this, but we'll see what happens. And I just moved it so that way you guys can see my main. But I just won't click on main right now, and we're going to get back into here, and we'll be able to watch it run. We're already down 8%, 9%, but here we can see it wicking up to plus 20% and things like that. So we're just going to see what happens. I really don't care what happens here because it worked in recent history. I'm really just curious to see if it ticks up or ticks down heavily from 2020 happening. But yeah, that's my own strategy. I might talk about it more in the future, but as of right now, I want to keep it close source in case I ever want to sell it. And yeah, okay, so here we see 2020. So maybe this will be good. Maybe we can see why and how it actually works. Wait, we actually didn't even crash yet. But we'll see what happens when we get there. Anyways, I hope that you guys learned something from this video. And if anything for me, whoops, the information from this back test yields it to be an effective edge. Yeah, here we see margin call orders up. You guys get a little hint on what this one is all about. But that's alright, these things happen in algo trading. And it's not, they never spoke about strangles. Oh, there's another hint for you. I don't know if you want it. But yeah, that's pretty much it. You can see how long I've worked on this. I want to see, what is this? Okay, here's a similar version of the strategy working from 2017 to 2022. I don't know what I changed to make it do this. I don't know what's different. I don't know what I changed, and I'm not going to put that code out. But, and here we can see that the crash actually made it pop a little bit. So, yeah, it's done. It's minus 106% return. It's actually almost totally inversed. That's pretty funny. I'm going to copy and paste this code and put it in there. But, that is all for the video. It was, how long is it? Almost a half hour. I gotta get better with making shorter videos. But, can't put a time frame on perfection, you know, because this was so perfect, you know, 5th time or 6th time was really the charm. But yes, that is all the information I'm going to give you guys in this video. Thank you again for all the recent views and recent support on the channel. Trying to grow it to 1,000 at some point. I don't know. I'm not going to put a timeline on it. But yeah, also you can see I called it cardiac arrest. We have the other ones called the card counter. This one is cardiac arrest. And now you guys know at some point, if for some reason, it's strangles and shy. But you don't know the code. You don't know the code. So someone's gonna figure out and be like, really? That was all this is? It always is. It always is that simple. It always is. But I'm rambling now, so I'm gonna let you guys go. My name is Joe Scorson. The channel is called Ethernet Wink. Will Smith that like button. And I will see you guys in the next video. If you have any idea, last thing before I let you guys go, if you have any idea for me to code or me to talk about, please leave it down below. I will do it if it has to deal with finance and trading. It isn't ridiculous. So I wanted to really leave that in there. If it's not ridiculous and it has to do with finance and trading, here's some more stats about the algorithm before you go. If you want to look at that, 91% win rate, 1-to-1 almost. All right, let you guys get out of here. Stay beautiful, stay fresh. I almost said stay black, but I'm not Joey Diaz. So, gonna get out of here. Good night, guys. My name is Joe Scorson. Channel is called Ethernet. Please come back in the next one. Peace out.